Most investors think they're smart until the market exposes the truth, because the market is the greatest lie detector in the world. It doesn't care about your confidence, your predictions, or how certain you feel. It only cares about the mistakes you make. And if there's one man who has spent a lifetime studying these mistakes, learning from them, and using them to build one of the greatest fortunes in history, it's Warren Buffett. But here's the shocking part. Even Buffett, yes, the Oracle of Omaha, made mistakes. Huge ones, painful ones, mistakes that cost billions. And yet, those same mistakes helped him build a net worth that most people can't even imagine. Because the truth is simple. Success in investing doesn't come from perfection. It comes from not repeating the same mistakes everyone else makes. So today, we're diving deep, very deep, into the 12 mistakes every investor makes according to Warren Buffett. These aren't theories. These aren't textbook rules. These are scars. Real scars from real decisions that shaped one of the greatest financial minds of all time. If you're serious about investing, if you want to avoid the traps that destroy 99% of investors, then listen carefully. This might be the most important lesson you ever hear. Most investors fall into a trap so deadly it wipes out millions of portfolios every single year. They chase whatever is hot. It feels logical, right? This stock is up 40% this month. Let me jump in. This sector is exploding. I need to get a piece. This company is trending on social media. I better buy before it goes to the moon. But according to Warren Buffett, this is the #1 wealth killer. Buffett says, "You can't buy what's popular and expect to do well." And that sentence exposes the truth. If everyone already loves it, you're too late. Hot stocks are like a burning match. The closer you get, the more confident you feel. Until suddenly the flame burns your fingers. History proves it. Dot-com bubble, cryptomania, AI hype cycles, EV explosions. Every generation thinks this time is different. But it never is. Because the psychology of fear and greed never changes. Buffett learned this lesson early. He once bought into a steel company simply because the industry was booming. The hype was high, demand was high, expectations were high, but the economics were bad. High competition, low margins, weak long-term durability. He lost money, not because the company was terrible, but because he let the crowd influence his decision. So here's the uncomfortable truth. If your investment thesis begins with, "Everyone is buying this," you already lost. Real investors do the opposite. They buy before the excitement and sell before the hype collapses. They study fundamentals, not headlines. They analyze cash flow, not TikTok clips. They focus on value, not velocity. The market rewards discipline, not dopamine. If you want to invest like Buffett, remember this rule. Be willing to stand alone, because the crowd is almost always wrong. The stock market is a device for transferring money from the impatient to the patient. If this is true, and it is, then the greatest mistake investors make is simple. They can't sit still. Most investors trade like they're sitting in a casino. Buy today, sell tomorrow, switch strategies next week. React to every piece of news, every tweet, every rumor. They don't invest, they gamble. And the more they gamble, the more they lose. Buffett, on the other hand, famously makes almost no trades. He holds companies for decades. He waits, he watches, he does nothing, until doing something becomes the obvious move. This is shocking to new investors because it's the opposite of how the world behaves today. Everyone is addicted to motion, addicted to action, addicted to the illusion of control. But here's the truth. The more you trade, the worse your results become. Why? Because emotions drive rapid decisions. Fear pushes you out of great companies. Greed pushes you into bad ones. Your brain becomes your biggest enemy. Buffett once bought and sold a media company within a short period, one of his rare rapid decisions. The result? He called it a $200 million mistake. He moved too fast. He didn't let the business speak for itself. He acted emotionally. And it cost him. So ask yourself, are you investing or are you reacting? Because wealth isn't built through speed. It's built through stillness. Buffett says the best investors cultivate a rich man's patience. And if you want to reach financial freedom, you must learn the same discipline. Let's get one thing crystal clear. Most investors fail not because they lack intelligence, but because they ignore the simplest rules of wealth creation. And one of the deadliest mistakes they make is underestimating the power of compounding. Compounding is not just numbers quietly growing in an account, It's the single most powerful force in investing. Albert Einstein famously called it the eighth wonder of the world, but most investors act as if it doesn't exist. They chase excitement, short term gains, and flashy stocks, completely ignoring the snowball effect of patience. Warren Buffett is living proof of this principle. He started investing when he was 11 years old. Imagine starting that early and letting time work its magic. Even modest investments, if held and compounded for decades, can become massive fortunes. Buffett didn't rely on luck or hot tips, he relied on time and patience. Most investors, however, behave the opposite way. They sell too soon. They panic during small market dips. They jump on every trending stock or next big thing without a real strategy. And because of this, they rob themselves of the most important wealth building force: time. Buffett's approach is almost shocking in its simplicity. He looks for businesses that can produce consistent earnings growth and holds them for decades. That's not exciting, it's not glamorous, but it's effective. And this brings us directly to mistake number 4: failing to understand the business you invest in. Buffett's rule is deceptively simple: never invest in a business you cannot understand. Yet, most investors ignore this advice. They buy tech startups they can't explain. They buy stocks because their friend said so. They chase a brand or a ticker symbol without knowing how the company makes money, what its competitive advantages are, or what risks it faces. Buffett's investment in See's Candies perfectly illustrates this point. He didn't rush in because of hype or trendy numbers. He spent months studying the business, the manufacturing process, the marketing, distribution channels, and most importantly, the economics of candy sales. He understood the moat, the durable competitive advantage that protected the business from competitors. Then, he bought the company at a reasonable price and held it. Decades later, See's Candies still generates significant cash flow. It's a textbook example of how understanding the business and letting compounding do its work creates lasting wealth. Contrast this with the typical investor, someone who buys the latest tech fad or meme stock because it's trending, only to panic sell when the hype collapses. They don't understand the business. They don't consider whether it can survive economic cycles. They don't let time work for them. They are blind gamblers. Buffett also emphasizes patience. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This advice is shocking in today's world of instant gratification, where investors flip stocks like they're trading cards. Most people won't wait. They won't endure small setbacks. And as a result, they never truly experience the exponential growth that compounding provides. Compounding is also psychological. It forces you to resist the urge to act on impulse. It forces you to focus on long-term fundamentals instead of daily market noise. Investors who ignore compounding miss the quiet, almost invisible growth that builds real wealth over time. Combine this with mistake number 4, investing in what you don't understand, and you have a recipe for disaster. People think they're making smart moves, but they're actually playing a dangerous game of guesswork. They might get lucky a few times, but over decades, luck runs out. So ask yourself these hard questions. Do I truly understand the businesses I'm investing in? Am I letting time work in my favor, or am I trying to force growth overnight? Am I chasing trends instead of fundamentals? Do I have the patience to let compounding work its magic over decades? The brutal truth is this: most investors fail because they ignore these 2 rules. They don't respect time, and they don't respect understanding. Buffett didn't get rich by guessing or reacting to trends. He got rich by analyzing businesses deeply, holding them patiently, and letting compounding do the heavy lifting. That combination, knowledge plus patience, is what separates the average investor from the truly wealthy. Here's the final uncomfortable point. The longer you wait to internalize this lesson, the more opportunity you lose. Every year that passes without understanding compounding and the businesses you invest in is a year your snowball could have grown into a mountain. If only you had been patient and informed. So, remember, mistakes. Number 3 and number 4 are not minor. They are silent killers of wealth. Ignore them, and you will watch others build fortunes while you chase illusions. Master them, and you're on the path to investing like Buffett himself. As we reach the end of this deep dive into the 12 mistakes every investor makes, there's a truth you need to face head-on. Most investors will never build real wealth. Not because they lack intelligence, not because they lack opportunities, but because they repeat the same fatal errors over and over again. The market doesn't forgive mistakes. It doesn't care about your confidence, your predictions, or your gut feelings. It only cares about results. And if you continue to chase what's hot, trade impulsively, ignore compounding, or invest in businesses you don't understand, the market will punish you. It's only a matter of time. Warren Buffett, the Oracle of Omaha, is a living testament to what happens when someone learns from mistakes instead of fearing them. Even he, the world's most successful investor, made errors, big ones. He lost money, made wrong calls, and misjudged industries. But the difference between Buffett and 99% of investors is this: he studied those mistakes, analyzed them ruthlessly, and never repeated them. Every loss became a lesson. Every misstep was a blueprint for smarter decisions in the future. And this is exactly what separates the average investor from the extraordinary: the willingness to learn, adapt, and endure. Think about it. How many investors panic when a stock dips 10% or 20%? How many sell out of fear, cutting their snowball short before it has a chance to become a mountain? How many chase the latest trend, the newest fad, the next viral stock, only to watch their money vanish when the hype collapses? These are not minor mistakes. They are wealth killers. They rob you of the compounding effect, of time, and of the opportunity to build lasting financial security. They are the silent forces that keep people trapped in mediocrity, working harder for less, hoping for luck instead of building systems that endure. Buffett's life and career show us an alternative path. A path defined not by chasing trends, but by discipline. Not by impulsive action, but by patience. Not by emotion, but by understanding. He invests in companies with durable competitive advantages, he studies them in depth, and then he holds them for decades, letting compounding multiply his gains. And here's the shocking part. This isn't complicated. It's not a secret formula hidden behind Wall Street jargon. It's principled, patient, and disciplined investing. The challenge is not in understanding it, it's in executing it consistently, while the crowd around you panics, chases, and trades recklessly. So, what's the takeaway for you? What should you do after learning about these 12 mistakes? Study your investments thoroughly. If you don't understand the business, don't invest in it. Surface-level knowledge is a trap. Deep understanding is armor. Embrace patience. Let your investments compound. Don't cut your snowball short. Don't panic during market dips. Wealth is built slowly, quietly, and methodically. Ignore the crowd. Popularity is the enemy of true value. When everyone loves something, it's usually too late. Stand alone if necessary. Make decisions based on facts, not emotion. Learn from mistakes, yours and others. Every investor loses at some point. What defines your future is not the losses themselves, but your ability to analyze them, adapt, and avoid repeating them. Respect time. Compounding requires patience. Don't rush, don't chase instant gratification. True wealth is a marathon, not a sprint. The reality is harsh. The market will test you. It will tempt you with sure wins and punish you for ignorance. It will amplify your emotions, your fears, and your greed. But if you internalize these lessons from Buffett, you gain something almost no one else has: control over your financial destiny. Let this sink in. The mistakes of other investors are your opportunity. Their panic is your advantage. Their ignorance is your path to wealth. If you can observe, analyze, and act rationally while everyone else reacts emotionally, you will consistently find yourself on the winning side. So take this knowledge and make it actionable. Write down your investment principles. Stick to them, even when it's uncomfortable. Study businesses, not stock charts. Let your money grow quietly while the crowd chases illusions. And remember, every decision you make today compounds into your future. Every mistake you avoid multiplies your potential. The market is brutal, yes, but it is also generous to those who respect its rules. And here's the final, most important point. You are not doomed to repeat the mistakes of others. You have the knowledge. You have the guidance. You have the roadmap from one of the greatest investors of all time. What you do next will define your financial future. So go forward with discipline, patience, and courage. Study relentlessly. Invest wisely. Avoid mistakes, and let the silent power of compounding transform your life. Because at the end of the day, wealth is not built by luck, hype, or emotion. It is built by those who learn, endure, and act with intelligence over decades. You now have the lessons. The rest is up to you.